Hello, my name is Gopala Vasudevan. Today we will talk about hedging strategies using futures contracts. This is from Chapter 3 of the Fundamentals of Futures and Options Market by John Hall. So first of all, let's talk about what is meant by a long hedge, what is meant by a short hedge, and so on. So a long futures hedge is appropriate when you know you will purchase an asset in the future and want to lock in the price. So what that means here is that suppose you are a US multinational, for example. You need to buy something, let's say from Europe. You need to have 100 million euros. In this case, you want to buy a futures contract or enough futures contracts so that you can purchase the 100 million euros. Okay? And typically this might take place at a later date. So let's take today is February, and let's say you want to buy something in June. You might want to enter into a futures contract. That's one example. Another example would be Southwest Airlines is an airline company, and one of their primary needs is heating aviation fuel, and for this they can buy futures contracts on aviation fuel, or most probably they might use heating oil. A third example would be a company such as McDonald's. They need wheat, corn, oil, orange juice, milk, and so on. So again, they can buy futures contracts or forwards contracts on these assets. So the main thing here is that whenever you know that you need something in the future, typically you want to buy a futures contracts. That is what you want to do. Now, what is the second example? The second one is a short futures hedge. And a short futures hedge is appropriate when you know you will sell an asset in the future and want to lock in the price. So here what we are saying is that we are somebody who either you own the asset or you expect to own the asset independent of the futures contract. So examples are, you could be a grain producer, you're producing corn, you want to sell it, and by selling the futures contracts, you know that you will get this price in the future. Another example would be you are a producer of oil. Again, in this case, you might sell futures contracts on oil so that you can lock in the sale price. So I think the fundamental thing here is that it is either when you know you will sell an asset. So there are two things here. The first is we are talking about somebody who either owns the asset or hopes to own the asset. Now, whenever you go and read the literature, you can always find quite a bit of information, the arguments for against hedging, and what are the arguments in favor of hedging. So what we are saying here is that companies should focus on the main business they are in and take steps to minimize risk arising from the interest rates, exchange rates, and other market variables. So what we are saying here is that, let's say you look at a company like Microsoft. Their main business is enterprise software, and they sell their products all over the world. So here what we are saying is that as far as Microsoft is concerned, they should focus on their product, they should focus on their competition, and they should focus less, or they should not be worried about interest rate changes, prices to their stock, prices of raw materials, and so on. So by hedging, it enables them to focus more on their main business and perhaps leave the rest to the finance people and so on. Okay. What else the argument against hedging? So the fundamental argument is that in finance, we always assume that shareholders hold well-diversified portfolios. So if shareholders hold well-diversified portfolios, it doesn't really help if the firm is hedging, because what we are saying is that the shareholders are hedging their own portfolios by having a diversified portfolio. So when one of them is a winner, chances are the other one would be a loser, and perhaps they can sell out. So they don't really have to worry about all the risk that they face. And one of the things we see here is that it might increase risk to hedge when competitors do not. So I always think about Southwest Airlines. So Southwest Airlines is a company that always use futures and forwards contracts and perhaps options contracts to hedge their exposure to oil. So what that means is that last year the price of oil was 60, now it's closer to 30. So if Southwest had used futures contracts based upon last year's prices, chances are they might be paying more for the oil when compared to the competitors who might not be hedged that much. So that is one of the things you find here. If you are the only company that hedges in a business, or if you are one of the fewer companies that hedge in a business, chances are it can actually increase your overall risk. And explaining a situation when there is a loss on the hedge and a gain on the underlying can be difficult. So I think, in this finance class, we will talk about, a set of assignments, a set of cases based on futures. This is a Harvard business case. And if you look at that case, one of them talks about a bank. A bank was exposed to interest rates, and they basically hedge. So they shorted interest rate futures. And the problem was that what actually happened was exactly opposite to what they expected, and that was interest rates went down rather than went up, which basically meant that they lost money on their futures position. And if you lose money on a futures position, which is expected to protect you, it might be a little bit tough to explain that to the people in your company, especially, let's say they're not finance people, let's say they could management and so on. They might really be concerned about what is happening. So the hedge was supposed to protect you, but you are losing money on the hedge. Now, a long hedge, the company or person is buying futures contracts to hedge against a certain risk. The price of platinum was 180. The futures price is 205. So this is basically what we are assuming is that this is a simple hedge. This is a perfect hedge, and based upon that, we will go through some calculations, but you don't really have to do any calculations. But basically here, what this will tell you is that you have the right to buy platinum at 205 using the futures contracts. You are perfectly hedged, and based upon that, whatever happens to futures prices, you end up paying 205. Now, the reason why I split that up into two parts and show the profit, loss, and so on is because in later examples, we will assume that things are not perfect, unlike what we assume here. So basically, what we want to do is we want to look at two markets. One is the spot market, and the other is the futures market. So we want to split up to see what happens in each of these markets. So if you look at the futures market, or in the futures contract, what we are going to assume here is that you basically had the right to buy platinum at 205, and at the end we are assuming that the spot price increases 280, the futures price is also going to be 280. So your profit in the futures market is 3,750, or it is $75 per pound. In the spot market, what we are assuming here is that the price was 180 initially, and your profit is going to be if you actually bought it, you're going to pay $280 per ounce. Okay, so 280 is, that is, be 14,000 minus the profit in the futures market. That gives you 10,250. So the price per ounce is going to be 205. So in the spot market, what we can assume here is that you're going to buy platinum at 280, okay, times 50. That gives you $14,000. Okay, that is your cost, minus what you paid for the platinum. Okay, sorry, what you make in the futures market. So 14,000 is how much you pay in the spot market, and the actual price paid is going to be 10,250, and the price per ounce is going to be 205. Okay, so this is what you see here. In the futures market, you made a profit of 3,750. In the spot market, you paid $14,000 for the platinum, and your net cost is going to be $205 an ounce. Okay. Now, what happens if you look at a financial futures relationship with interest rates? We are talking about a December T-bond futures contract. The price is 67.17. So if you remember what you did in the case of bonds, typically what we assume is that the prices are quoted in 17 by 32, and that is 67 and 17 by 32, or 0.6753125, or the price here is going to be $67,531.25. So we are assuming that is a bond with a face value of $100,000. So if interest rates go up, the value of the futures contract will decrease, and if interest rates go down, the value of the futures contracts will increase. And what we say that, the reason why we say that is because, again, from previous finance courses, we know that interest rates and bond prices move in opposite directions. So as interest rates go up, the price of the bond will go down, and because of that, the futures price will also go down. Okay. Now, short position involves the sale of a futures contract and the expectation that the interest rates will increase. So basically here, what we are saying is that if you are shorting the bonds, what we are hoping for is that right now, let's say the bond price is 100. If interest rates go up, it might go to, let's say, $95, in which case you can buy the bond at 95 and cover your position. Okay. So this enables you to purchase a contract at a lower price than you sold it for. So that's what we are doing here if you want to profit in the futures market. Okay, so let's look at this example. Assume you buy a December contract at 67 and 17 and interest rates increase, thus result in a lower contract price, say to $60. So in this case, you paid $67,531.25 initially. Now the price is $60,000. So you are, if you are a short position, what you do is you sold initially and you can buy it back at lower price. But here we are assuming that, let's look at the person who bought this contract initially. Okay. Now they could sell it for the lower price, which is $60,000. They lose $7,531. But if you are short initially, you sold it for $67,531.25, and now you can buy it for $60,000. So you make a profit of $7,531.25. So as far as the futures market is concerned, if you expect interest rates to rise, your strategy, if you want to profit, would be to sell the interest rate futures. If you expect interest rates to go down, your strategy would be to buy the interest rate futures, because now you bought it at a lower price, and as the price goes up, you can sell the bonds for a higher price. Okay. So who are typically affected by rising interest rates? Bond portfolio managers and banks. And the reason we are saying is that, bond portfolio managers hold a portfolio of bonds, and as the interest rates go up, the value or the price of the bonds will go down. What about banks? If you remember what you did in financial intermediation, one of the things you might have studied is that banks are exposed to interest rate risk. So typically the assets, which are the loans they have, tend to be of a higher maturity than the liabilities, which is their the CDs and other things that investors invest with them. So here, as interest rates rise, they are exposed to interest rate risk, and one of the ways they hedge their position is by using interest rate futures, or typically by selling interest rate futures, so that they can hedge the gap between their assets and liabilities. Now this is a little more tough, and the reason why it's a little more tough is because we are going to talk about hedging when there is risk, when there is basis risk, and so on. And here what we find is that we want to talk about something referred to as basis risk, and basis is the difference between spot and futures. Basis risk arises because of the uncertainty about the basis when the hedge is closed out. Okay, so basis is, we want to talk about what is basis, and we want to talk about the basis risk, that because of which you may not be able to hedge perfectly. Okay, so in this example, what we are doing here is that let's look at the case where the initial futures price is F1, the final futures price is F2, the final asset price is S2, and you hedge the future purchase of an asset by entering into a long futures contract. So what we are saying here is that we need something, we need the asset. So that could be coffee, that could be milk, that could be gold, that could be oil, that can be anything. So what we are going to assume here is that you do two things. One is you buy a futures contract initially, and at the end you close out your futures position. So in the case of the long hedge, you bought the contract initially. Okay, so you have a long futures contract, which means that you bought it initially, and then at end you sell the futures. Okay, so if you look at the actual cost you pay for the asset, that is going to be the final futures price, sorry, the final spot price. So whatever the price is at the end, which is S2, minus the profit or loss in the futures market. So what do you do in the futures market? Initially you had bought the futures, at the end you will sell the futures. So if you want to figure out S2 minus F2 plus F1, that is F1 plus basis. So what does it tell you? It tells you, if let's say you are Southwest, how much did it cost you to buy the oil? If you are McDonald's, how much did it cost you to buy the coffee, the milk, and so on? Okay, so that is your effective cost. That is going to be the S2 minus F2 plus F1. So S2 minus F2 is that basis. The S2 minus F2 is basis at T equals 2. Okay, that's what we are doing here. So the cost of the asset is given by the final spot price, the spot price at the end, plus the basis. Sorry, the spot price at the end minus F2 minus F1, that is going to be the initial futures price plus the basis. So whatever the futures price we entered into plus the basis. So now one thing you want to remember here is that if life is perfect, if we have a perfect hedge, the basis risk is 0, and that is why in the earlier example the cost of the asset was the same as the initial futures price. Okay, so here producer buys the platinum futures at 205, assumes spot price increases in 8 months to 280 per ounce, and the price of the contract has increased to 325. One contract represents 50 ounces. So what are we doing here? He bought a platinum futures at 205 and the end price is 280, and the price of the contract is 325. Okay, so why do we have basis risk? The main reason why we have basis risk is because the futures contract expires at a later date. So when he wants to close out the position, the futures price and the spot price are not the same. So we want to look at what happens in the futures market. In the futures market, he bought the contract at 205, and at the end it's 325. So he made $6,000. In the spot market, basically he lost $5,000, and the actual purchase price is going to be the whatever he pays in the spot market at the end, which is $14,000 minus the profit he made in the futures market. So it's going to be $160 per ounce. Okay, so we can do it also in an easier way, that is the F1 plus the basis, or initial so that is going to be the initial futures price was 205. So 205 plus the difference between the spot price and the futures price. So the spot price is 280 minus 325. Okay, so you can either use the formula or you can do it in two steps. That is, find out the futures market price, initial price, plus the basis at time t equals 2. That's a straightforward answer. Or we can assume that he goes to the market, buys it at 280, and he closes out his futures position. Okay. Now, what about the short hedge? So for a short hedge, the same numbers, what we find here is that the price he or she gets is what's going to happen is that, let's say you are a coffee producer, you sell your coffee in the market at time t equals 2, you get the final asset price. At the same time, you close out your futures position. So the price realized is the spot price, that is the price at time t equals 2, plus the profit or loss in the futures market. And what we are assuming here is that initially they sold it at F1, now they're going to buy it back at F2. So the price realized is F1 plus basis. Now what we see here is that the F1 plus base is the same for a long hedge and for a short hedge. Now why is that true? As the main reason being that, what the buyer makes, the seller will lose. So it is a zero-sum game. Okay. Now why do we have basis risk? The main reason why we have basis risk is because typically you want to choose a delivery month that is as close as possible to, but later than the end of the life of the hedge. So what does it mean? Basically what we are saying here is that suppose you are, let's say Walmart, you want to buy something from China in June. You typically want to use a contract that expires at least 1 month later or maybe 15 days later than the expected delivery date. And that way you have some flexibility, because in real life it never works out as planned, and that is the main reason why you want to give yourself some flexibility. The second reason why we have basis risk is because when there is no futures contract on the asset being hedged, choose the futures contract that is most highly correlated with the asset price. These are the two components of basis. So what we are saying here is that in real life, suppose you're a portfolio manager, you have a bond portfolio, you are buying corporate bonds, and to hedge your portfolio you might be using treasury bonds. So in this case, the asset being hedged, which is a corporate bond, is not the same as the futures contracts being used, which are treasury bonds. So because of that, you face what is referred to as basis risk. Now to summarize, why do people face basis risk? One is the contract use is typically expiring later than when you need the asset, and the second one is that when the asset being hedged is different from the futures contract being used. So in these cases, what we look for is that we know that we cannot hedge perfectly. So what we are trying to do is that we are trying to minimize our risk exposure. How can we do that? The way we can do that is by hedging a certain portion of our needs. And how do we figure that out? Basically here, the optimal hedge ratio, basically what it tells you here is that what portion of your needs should you be hedging, and that is given by rho. Rho tells you the correlation between the asset being hedged and the futures contract being used. Sigma S tells you the standard deviation of the spot price. So if you are looking at, let's say the treasury bonds, we are talking about the standard deviation of the prices of these bonds. If you're talking about corporate bonds, that would be the standard deviation of the corporate bonds. And sigma F, if you're a portfolio manager trying to hedge corporate bonds using a portfolio of treasury futures, then sigma F tells you the standard deviation of the futures contracts. So sigma S is the standard deviation of delta S, the change in the spot price. And let's say your Southwest Airlines, typically you want to hedge your exposure to aviation fuel. The contracts you might be using are futures contracts on heating oil. The reason why you want to use heating oil futures is because perhaps they are more liquid. So in this case, sigma S is a standard deviation of delta S, the change in the spot price. So here we are talking about the change in the price of aviation fuel, and sigma S is a standard deviation of the futures price, and that is, we are talking about futures contracts on heating oil. And rho stands for the correlation between delta S and delta F. So basically here we are talking about the correlation between the price of heating oil futures and the aviation fuel prices. Okay. Now what about a portfolio manager? So typically if you're a portfolio manager, you might want to protect your portfolio, and one of the ways you can do that is by using futures contracts on the different indexes such as the S&P 500 or the Nasdaq and so on. So to hedge the risk in a portfolio, the number of contracts that should be shorted is given by beta times the portfolio value divided by the value of the futures contract. So here of the asset underlying one futures contracts. Now, why should you want to hedge? There are a couple of reasons why you want to hedge. The first is desire to be out of the market for a short period of time. Hedging may be cheaper than selling the portfolio and buying it back. So let's say you're a portfolio manager, you have a $100 million portfolio. You're going to spend a lot of money in transactions costs to pay your broker and so on if you want to sell all the stocks and buy them back. Using the futures is much more easier and much cheaper. The other is desire to hedge systematic risk, appropriate when you feel that you have picked stocks that will outperform the market. So if you look at a hedge fund, at least in theory, their objective is they try to pick a set of stocks that can outperform the market, and at the same time, they want to hedge their market risk. So the reason why we call them a hedge fund is because this is their strategy, hedging the market risk and having a superior portfolio of stocks that can outperform the market. And to do that, futures are a good choice. Okay. So let's look at one more example. The value of the S&P 500 is 1,000. The value of the portfolio is 5 million. The beta of the portfolio is 1.5. What position in futures contracts is necessary to hedge the portfolio? So clearly, you own the portfolio, you want to hedge, you want to short stocks. That is the first thing. What position is necessary to reduce the beta to 1.75? What position is necessary to increase the beta to 2? So basically, the formula we want to use is, the first time we are assuming that we want to hedge completely. And if you want to hedge completely, that is given by beta S over F. So the beta of the portfolio, which is 1.5, times the market value of the portfolio, which is 5 million, divided by 1,000. So where do we get the 1,000? 1,000 is the level of the index and 250 is a multiplier. So there, for different types of contracts, there are different multipliers, and here it's 250. So what that tells you is that you have to sell 30 contracts. Now, number of contracts needed to make the beta equal to 0.75. That is given by the beta new minus the beta old times the portfolio value divided by the value of each futures contract. So what we see here is that you want to make it go down from 1.5 to 0.75. The other numbers are the same. So the number of contracts you need is 15, which is exactly half of what you needed earlier. Now suppose you want to make it go to 2, then what we see here is that your current beta is 1.5. You want to make it go all the way to 2 times 5 million divided by 1,000 times 250. So what we find here is that you want to buy 10 contracts. So the opposite sign is there, and that is the number of contracts needed is going to be 10, which is a positive sign. Here it's going to be minus 15. Okay, and at the top again it's going to be a minus 30, although there is no sign given if you use that formula. Okay. Rolling the hedge forward, we can use a series of futures contracts to increase the life of a hedge. Each time we switch from one futures contract to another, we incur a type of basis risk. So what we are saying here is that suppose you want to hedge for 18 months or 2 years. Typically, the futures contracts that are liquid tend to be 1 year or less. So what that means is that we want to use a series of 1 year contracts when we have to hedge for a longer time period. So to summarize, I think this is an important chapter. This talks about hedging, and hedging is important, and one of the main things you want to remember is that hedging basically means that you are not trying to make a profit or loss, you are trying to protect your portfolio. So it's not like trying to make money on the futures contract, but using the futures contract or the forward contract to hedge your position. And we talked about two types of hedges, a long hedge and a short hedge. A long hedge is usually done when you need the asset, which means that if you need oil, you want to buy futures on oil. A short hedge is something we do when we actually own the asset or expect to own the asset. And we talked about basis risk. So basis is the difference between the spot price and the futures price. And what we said was, in real life, typically a hedge is not perfect. We face basis risk. The two reasons why we face basis risk is because the asset being hedged is not the same as the futures contract being used. The second is that usually to give some flexibility, we want to use a futures contract which expires a little bit later than when you actually need the asset or when you want to sell the asset. So these are two reasons why we have basis risk. And what is the formula that tells you the effective cost you incur or the effective price you pay? That is given by the initial futures price, which is F1, plus the basis at time t equals 2. So good luck. You want to make sure you're comfortable with this material.